Welcome, everyone. Thomas Montgomery, IIMFL and Smart Money Alliance. It's a beautiful Thursday morning. It's November 19th, 2020, 7:59 a.m. Central. We get together with our distribution partners most Mondays through Fridays at this time and talk tips, techniques, strategies, best practices, and so forth. What we're going to talk about today is in an abbreviated discussion, 15 minutes or less. Let's understand the economics of working together to have a joint venture incubator. So a little backdrop. Why did we come up with the incubator concept? Many small businesses, especially early stage small businesses, lack the credibility factors to get funding, or at least many types of funding. So they often don't have a commercial address, a business phone number that's listed as directory assistance. They often don't have QuickBooks. They're not producing income statements and financial statements. They often don't have a website, a branded email. They're using Gmail, Yahoo, and all these consumer grades. So what we came up with is an incubator model. We've launched the first one. I'm sitting in it right now, and we're launching several others with many of you. But I think there's a real interest and maybe a little bit of confusion of how does the money work? How does the money flow if we do a JV incubator, joint venture incubator? And that's what we're going to discuss today. So again, you can always go to our website, iimfl.org/incubator for more information. But here what we're going to do is we're going to project out kind of an ideal scenario of the first 6 months together. Now, the incubator doesn't end after 6 months, but by then we've ramped up and are at stable state. Now, granted, we're looking at an ideal ramp up. So you could be conservative and say, no, I think we'll accomplish only 80% of that, or 70% of that, or 50% of that. But regardless, let's look at an ideal ramp up. So we have a simplistic projected income statement here, looking at income, expenses, and projected net income. Now, when we do a joint venture incubator, we're going to split the income 50-50. So on a monthly basis, pretty good income, but that's the end result. Down here, we have our different assumptions. So we'll start at the bottom and work our way up. We're assuming that each client that enrolls into a joint venture incubator that you and us have set up, they're going to pay a $9.99 deposit. We're going to assume that as we set up their loan package, because anyone that's in the incubator, they're guaranteed at least $100,000 capital raise. So we're building their loan package and building financial literacy. And we assume that the average key person policy commission is $1,000, which is shared. We'll talk about that in just a second. And then we're going to assume that the average capital raise is the minimum $100,000. Now that's what we guarantee. So certainly some people will have higher than that, but we're going to be conservative on that variable here and just assume that we're going to help the average client raise $100,000, and 6% of $100,000 is 6%, generating $6,000 of performance fees per client. Now, not all these things happen in the first month for new clients, right? So let's get up here and look. We're going to assume that we're going to add 100 new clients a quarter. That's our goal with these JV incubators, 100 clients a quarter, which is about one a day, about 30 a month, just slightly over. So of course, it's technically 33 new clients per month. Now, they won't stay with us forever, will they? Because our goal is to get them funded and out on their own. So the term incubator means that we're a resource, a support. We're providing the infrastructure for them, but that doesn't mean that they're dependent upon us and with us forever. So we're going to assume that the average incubator has a capacity of 100 active clients. That doesn't necessarily need to be the case, but that's a good estimate, a good round number. So we're going to add 33 new clients per month. So we're going to ramp up and we'll be full after about 3 months, but we're going to always be losing clients because they're going to be graduating out, but I'll get to that in a second. Here, just for the assumptions above, I needed a specific row of data of how many clients that are in month 2. Why is that? Because we don't anticipate that they're going to get funded in the first month. We anticipate that most of them will get funded in the second month. Therefore, that's why this row of data was needed. Graduated clients, again, we're assuming after 3 months, 3 to 4 months, then they're flowing out because they're ready to spread their own wings and be freestanding and not continue to occupy our limited resource of how many clients we can manage in the incubator. And then this row here is just the cumulative number of running clients. So you can see we had 33 in month 1, 33 more in month 2. So now we have a cumulative of 66 clients in our JV incubator. Now at month 3, by adding 33 more, we're pretty much full. And then each month thereafter, we're losing 33 that have graduated, but bringing 33 on. Of course, it's not going to be that exact and that clean, but this is a projection. And of course, we can provide this to you so you can change some assumptions if you feel that you need to. Okay, so now we have the assumptions. Let's go up to the dollars, because the dollars are generated as a formula off of those assumptions. 3 primary revenue streams coming into the joint venture incubator, the first of which are the deposits. Again, clients submit a $9.99 deposit when they enroll in the incubator. And that is important because we're providing a lot of setup for them, aren't we? We're going to set up with the Secretary of State, get their business filed, whether it's an S Corp, C Corp, or LLC. We're going to get their EIN, which of course is at no cost. We're going to set up their website. We're going to set up their phone system. We're going to get them QuickBooks so they're able to track revenue and expenses properly and so forth. So there's deposits that come in, and this is a function of $9.99 per new client times the number of new clients. And so you can see the formula there that matches. And so then that's actually consistent all the way across the board, because simplistically, we're assuming that we're consistently adding 33 new clients a month. Again, we can tweak those numbers and think that it might be more in some months or less in others, but for a simplistic revenue projection, that's what we have. Now, secondly, we have key person policies. So what you and I know is that lenders really like to have the assuredness that if the borrower should die, that they won't be left out to dry. That in fact, that there's a policy in place that will pay off the lender in case the borrower should die. Some sources of capital require that, some prefer it, some it's optional, but it's a normal part of the loan package that you and I'll be creating for these clients that are in your or my joint venture incubator. We're going to use a very specific type of policy that's called ROP, return of premium. It's beautiful because the client will buy the policy. If they die, it'll pay out. If they don't die, they get their premiums back. So obviously that's much more palatable than saying, hey, spend money on insurance. We don't know if you'll need it or not. So it's called ROP, but we'll take care of getting you all set up on that. But the bottom line is that we're going to be including that. We're going to have 33 clients in the month. We're assuming a commission of 1,000. And so that's where we get 33,000 from, isn't it? The third revenue stream, and again, that stays current because that's going to be part of the new client setup, and that happens in the first month. So these two numbers are stable from the get-go only because we're assuming that we're consistently adding 33 new clients a month. If we start to change how quickly clients come in, of course, the revenue will change as well. Then we get to the performance fees. We do not anticipate to get clients funded in their first month. We need to get them in. We need to get them onboarded. We need to get them through the 4-week curriculum. Therefore, there's no performance fee in the first month, and that's why we don't have a real strong financial performance in month 1. We're projecting just at 66,000 of gross income in month 1, which isn't bad for a startup, right? Because technically in this model, our joint venture incubator is a startup. Now, is that profit? Obviously not. There's always going to be expenses of operating a business, but we'll get to those in a moment. Now, the gross income builds nicely starting in month 2 because now performance fees are kicking in, and we can change the assumptions and say, no, not everyone will get funded in month 2. Some will get funded in month 2. Some it'll take to month 3 or 4 or what have you. We can alter that. It really doesn't change the ultimate profitability, just changes the timing of the revenue. But for simplicity's sake, we're going to leave it as that. So from a gross income perspective of a joint venture incubator, month one is kind of skinny, but starting in month two thereafter, we're doing really well. It's all contingent, of course, on filling the incubator up. But that's not a real challenge because we can drive in. We should have a wait list for our JV incubator because we have those existing startup businesses that are out there. And then secondly, we'll do a fair amount of education through the JV incubator, reaching out to prospective entrepreneurs. We'll be aggressively reaching out to newly formed businesses, those people that have home-based businesses, those that have just started a DBA in our we can pull from the database and invite them to participate in the incubator. So getting prospects, well, we have the prospects, getting clients for the incubator is not a challenge. Okay, so there is our income projections. Now let's drop down and get to expenses, because again, you're not going to expect to have a business with all profit. There's going to be expenses. The incubator license fee is $1,000 a month. That's what we charge to be able to set this up and manage it and operate it. So do we do this for free? No, we don't. We have to pay our overhead just like any other business. So it comes in payments at $250, so it's very affordable, but that is the first expense. Pretty minimal, right? Man, if I can bring in 65,000, 66,000 or more, and my cost of doing business is 1,000, I'll take that anytime. But anyway, let's move on. Now, we're going to also have cost of getting these clients started. We're going to have to get their entity formed with the Secretary of State. We're going to have to get their phone system set up and their website set up and so forth. We'll absorb the maintenance fees for all of those things, but the startup cost is going to technically come out of the upfront deposit, because the upfront deposit is not just profit, there's expenses. We're spending a fair amount of that to help each client get set up. So this is a formula assuming that our startup cost is around $700 per client, and then it's a function of how many new clients. But since we're assuming a steady state of 33 new clients a month, to no surprise, our startup cost projections are the same. We would like you to take a salary. You do not have to take a salary, but we would like you to take a salary. $10,000 a month is a good number. If you want more, we can discuss that. I wouldn't go lower than that, but ultimately, we need to set a salary for you because you're really managing the joint venture incubator. We're providing the back office and support and infrastructure, but you are the manager. So we're going to assume that you're pulling a $10,000 a month salary. We really prefer that you set this up as W-2 income. So it's contributing to your Social Security, it's documentable income. And then what that'll allow is the additional profit distribution that you'll receive each month then is not subject to employment taxes. All right, so here again, the assumption is that you're pulling a $10,000 a month, $120,000 a year salary as an incubator manager. The last row of expenses you'll notice is not listed, because when we set up an incubator with a JV partner like yourself, the question is, do you want to office it here within our existing headquarters? If so, then this will be blank. It won't add additional expense. But some of you, like Will's on the line, he's going to go lease a building in New Jersey. Well, guess what? There's going to be a cost to lease that building. You know, we're already paying for our space. We're already paying for the internet. We're already paying for the IT support and the security. But if you don't want to domicile your incubator at our address, which you don't have to, then we're going to have to figure out what the budget for these expenses are. But if you domicile it like Ed's going to do, even though he's not in East Texas, we're going to domicile his joint incubator here, so we're able to eliminate all those expenses. So, to no surprise, the projected net income is the difference between gross income and then the total expenses here. First month is a little skinny, $31,000, but you still got a $10,000 salary, which is a good start. And then we do a 50-50 split of the net income with a few variances we'll talk about over here in a moment. But then you'd have around $15,000 profit distribution in month one. Gets a lot more handsome once the clients are in. So you'd be looking at about a 6-digit profit distribution per month after a month 2 and thereafter, if we're hitting these numbers. Now, again, you might say these numbers are too aggressive. We need to lower our expectations. That's fine. It's an editable spreadsheet. So let's conclude with talking about how we specifically split the money so there's no misunderstandings or false expectations. So of the deposit income that comes in, the $9.99 a pop, we split that 50-50. So obviously it's about $500 a pop to you, $500 a pop to IIMFL. For the key person policy, we have an agreement at 100% comp level with the IMO. We'll split that 50-50. So that's putting on average another $500 a month into your pocket. So you're getting half of this, half of this. That's what we're talking about over here. So now you're looking at around $1,000 of income per incubator client coming in. And of course, the goal is to average the addition of about 1 a day, about 30 a month, specifically 100 a quarter. The performance fees, we charge the client 6% of the performance of their capital raise as a performance fee, very similar to what they would pay if they were doing a real estate transaction. We split that, you get 3%, we get 3%, and that's built here in these assumptions. Now, number 4, there's got to be startup cost of getting these clients going. It's not free to set up their website or to set up their phone system. We, IIMFL, we absorb the ongoing support cost. But for the initial startup, I just don't want you to think that $9.99 is just pure profit. There's going to be expenses. And we disclose that. We're assuming that we're going to spend around $700 of that $9.99 to get them set up. So of course we're splitting that because it's a 50-50 split here. You can't take half the income and not take half the expenses. As I mentioned, we'll absorb the cost for the ongoing support of the phone system, of their website. We're going to continue to pay their QuickBooks. That will not be your burden. That will not reduce your profitability. Your incubator manager salary is going to be offset against your 50%. So it's being paid by the incubator that we're operating together. That's true. But if you come in and say, no, I want to earn $20,000 a month salary, great, it's done, fine. Earn $20,000 a month, but that offsets against your part of the profitability. And then again, what I mentioned here on row 12, there is no incubator overhead cost if you want to plug your joint venture incubator into our current headquarters, because the infrastructure is already here. The lease is already signed, it's already paid for. But someone like Will that's going to do it in New Jersey, guess what? You're not going to get space for free. There's going to be expenses that's going to be covered. So with all that said, this is the economic model of doing a joint venture incubator. We would love to partner with you on this. I encourage you to go over to our website, learn a little bit more. Down at the bottom of the page, you can let us know that you're interested, send an inquiry in. We can visit individually and get that set up. Thanks, everyone. Look forward to visiting with you again tomorrow morning. Have a good day.